Hello and welcome everybody to today's very special presentation. So today we'll be covering the 5 secrets to trading gold in 2015. Why is gold the world's favorite metal? Essentially, gold is the world's oldest currency. Gold has been used as a form of money for thousands of years, partly because it is independent and it holds its purchasing power. An ounce of gold today will still buy you as much food, clothing, and energy as it did 50, 150, and 1,500 years ago. So let's fast forward to today. Goldman Sachs has reported 902 million in commodities revenues for 2013, which includes gold. Citi Investment Bank commodities trading revenues almost double, up 90% in the first quarter of 2014. Even President Barack Obama is investing in commodities. The White House has launched a 10 billion commodities fund in August 2014. So let me introduce you to the Gold and Silver Club, and welcome to everybody here as well as everybody online as well. So I'm Phil Carr, professional trader, trainer and speaker. I'm the co-founder and director of the Gold and Silver Club. I do specialize in teaching people how to trade commodities. So those include gold, silver, oil, natural gas, the agricultural commodities. I train thousands of individuals to become independent traders and successfully manage their own investment portfolio. Also responsible for the research and the development of the Gold and Silver Club trademark strategies, which have a proven track record of generating returns to traders, and a regular contributor to a number of financial publications, speak at a lot of different webinars, workshops, and events such as these. Joining me in running the Gold and Silver Club is Nick Kalsi, professional trader, investment analyst, and speaker. Nick began his career within private wealth management in 2002 before making the transition into proprietary trading. And prior to co-founding the Gold and Silver Club, Nick spent several years coaching professional fund managers and traders internationally for some of the world's top-tier hedge funds and investment banks. Nick is responsible for the commodities analysis and research which relates to the Gold and Silver Club proprietary trading strategies. Nick has written many articles on monetary economics and regularly writes for a number of global business and financial publications. We've appeared frequently on financial television. So that's just a bit of background on the Gold and Silver Club. We're really seen as the go-to guys and commodity experts on financial television, also the go-to guys in a lot of commodities press as well. So you're definitely in safe hands today. So we'll start off with the first secret to trading gold in 2015. The first secret to trading gold in 2015 is the US dollar index inverse correlation with gold. Now this is very important. So particularly, this is most seen during major news announcements, but the inverse correlation with the US dollar index and gold is incredibly important if you trade the gold market, particularly for your day trading and your longer term positions. So essentially, when the US dollar index sells off, gold will go up. And if the US dollar index rises, gold will go down. So where are we at the moment with the US dollar index? This is the 10-year chart for the US dollar index. Currently, we've actually broken out beyond 2-year highs for the US dollar, which has put a lot of pressure on the gold market. And we can see this very recently. Gold broke down to 2014 lows. Not just that, we broke down to 4-year lows on the Federal Reserve statement, which I'll discuss in a little bit more detail shortly, which was in October, which ended quantitative easing. And this, we saw a breakout to the upside for the US dollar, breaking out to 2-year highs, and this put a lot of pressure on the gold market. If you know that in advance, and when you're trading these markets, if you're looking at the US dollar index on a news announcement and you're looking to position yourself for a sell short, for example, with gold, of course you can make money from gold when it sells off as well as when it rises. Using the US dollar index for these trades gives you a lot more confidence in your trade, and you can use that correlation to your advantage. So for example, on the Federal Reserve statement going back to October, when the news broke that it had been the end of quantitative easing, we saw a breakout on the US dollar index, an immediate sell-off on the gold, which there was plenty of time to get into this trade, and we could see with the US dollar index breaking out to 2-year highs, we had plenty of opportunity to sell short gold. So that is the first secret to trading gold. You must must pay attention to what the US dollar index is doing. This is not just for gold, it's for platinum, for palladium, for gold, for silver. It's very important if you trade the precious metals. You must keep an eye on the US dollar index, which is currently also sitting near 3-year highs at the moment. The second secret to trading gold in 2015 is the gold daily cycle. So if you intraday gold, if you intraday and day trade gold, this is very important to know how the ebb and flow of the markets over the European session, the North American session, and the Asian session. So when the market starts the week on the Sunday Open and the Asia Pacific Open, often what we will see is the price of gold and the precious metals will rise from the Sunday Open, which is important if you've got a sell short position on gold and you're holding it over the weekend. So essentially you want to be very careful if you're selling the metals into the weekend not to hold positions over the weekend when we do expect buying on the open from the Asia Pacific market. This is seen regularly. So into the evening, overnight, we often see Asia Pacific buys gold. Then comes the European session, and this is often, particularly if we're going to have a large smackdown with the gold market and also the silver market, we'll often see this start to occur from the European session, which will follow through into the London session. Now, if we've been bearish in the morning from gold, particularly if it's broken through some key levels during the morning, you can bet that's going to continue right through to the afternoon from the US session. You don't want to be going long gold if it's been selling off during the UK session. You need to wait. And typically in the afternoon, so the US session, so in terms of Central Africa time, you're going to be looking at around about 5:30 is when we'll normally hit the low of the day for the gold market. So if you're intraday day trading and you're selling short, that is a very good opportunity for you to come out of some of your profits if you've been selling. And it's also a good opportunity if you see a good setup on the daily, that's a good opportunity for you to get in long gold if you to take advantage of this intraday cycle, because often we will see this position start to rise over the close of the UK session into the latter part of the US session and then into the Asia Pacific session. Perfect example actually was yesterday. We saw gold break out during the previous session the day before in the Asia Pacific session. It sold off during the UK and also the American session, and just last night it broke out again and it sold off again during the UK session. So very important. That's really the second secret you need to know for trading gold, particularly if you're day trading it, the very regular gold daily cycle that we get. Also, you need to be aware of the average daily price movement on gold. So this will stop you from trying to reach too much in terms of profit on your gold trade for a day trade. It will give you a target. So we often see the gold market move circa about 250 points per day. That's its average day-to-day volatility. So if gold has already moved 250 points that day, let's say it's been selling off. It's been selling off during the European session, the UK session, you come to the market, and you see gold is already down 250 points of the day. You do not want to start selling short. It's already given what it's likely to give during the day. It's now likely to retrace, have some profit taking, and it's not a good time to get in. However, if you've seen there's been very small volatility on gold, and the market's hardly moved, maybe it's been 10 to 15, 20 points that day is all it's moved, you know it's due a breakout. So if it's due a breakout, you want to position yourself for that breakout, and you can reasonably expect another 200 to 230 points for a breakout. Very important. And if you're in a trade which is doing really well, let's say you're up 200 points on the day on that trade, you know it's time to start thinking about getting out of that position. There's not much more to give on gold for the daily. It gives you a very good idea of what you can use for a profit target and when you should be closing out of that position. So it's very important to know the day-to-day volatility for the gold market. And if you compare that to some of the majors and Forex, often you see 20 to 50 points per day. It's a very lucrative market to trade gold. It's very day tradable. It moves more than most Forex pairs in a day, which means, particularly for us as gold traders, we have opportunities to trade gold very frequently, and we don't need to necessarily hold on to longer term positions. In fact, you can make more money on gold being in and out on a regular basis, alongside having a core position, which I'll talk about very shortly. The third secret to trading gold in 2015 is news trading. So key fundamental drivers for gold. The United States non-farm payroll and FOMC announcements are the two most lucrative trading announcements that we get for gold and commodities trading. The Federal Reserve announcement by Janet Yellen, the announcement which is given, has more influence over the US dollar than any other person, Janet Yellen and the Federal Reserve. And remember, the US dollar is very important for our gold trading because the US dollar moves inversely to gold. So if the news breaks the US dollar to the upside, we see a big move, we can expect gold to sell off and vice versa. It often gives us very lucrative trading opportunities, both technically and fundamentally. There are 8 lucrative trading opportunities per year with the FOMC, and the next opportunity will be the 16th of December. Mark's actually going to talk you through a position that was taken in October on the Federal Reserve announcement and how that was traded on the local markets and how it could have been traded. So we'll be talking about that a little bit later on. But I'm just going to give you some examples over the last 4 years. So previous FOMC announcements, 2011 through to 2014, how we traded these, some of the large moves that we got on the market. First of all, September 2011, Fed Operation Twist. So this was a 700-point move in 24 hours. It was a technical trade as well as a fundamental trade. We broke through some key support and we just continued to sell over 24 hours. It was a huge move. This was when silver was trading in 2011. Gold and silver were trading near all-time, well, certainly all-time highs. We had silver trading near $49 an ounce and gold near 1900. And this is where we had a huge sell-off on the market. And this was all started, the downward trend, which has been in the metals, started from the Fed Operation Twist. Very lucrative trading opportunity. September 2012, the Federal Reserve announced a quantitative easing where they're going to print additional US dollars, which then causes more upside for gold and silver. We saw a 500-point move for gold and a 200-point move for silver in just less than 3 hours. So very lucrative trading opportunities. Then in June 2013, last year, we had gold drop 900 points within 48 hours. Again, very good technical setup. We had a consolidation. And remember, when gold is just consolidating, the longer it consolidates, it tends to coil up. And any market this is relevant to, but particularly for gold, the longer any given market stays within a very tight range, it gives traders more opportunity to position themselves either side for pending orders and to take notice of this market. And finally, when it breaks out, we often get some really volatile and very good trading opportunities for breakouts. This was September 2013, where the Federal Reserve was expected to announce tapering, and they didn't. And we saw an immediate breakout on gold and silver, 600-point move breakout within just a few hours this time. So a very lucrative trading opportunity. Again, range-bound prior to the announcement. Once the news had broken out, we had a technical trade, a fundamental trade. You marry them together. You see the US dollar index selling off. You go long gold. Very lucrative trade opportunities. This was June 2004. This year, gold soared 400 points in just 24 hours, again, off a Federal Reserve announcement. And we've got September 2014. We've got a video online actually documenting us talking through each step of this trade where we made $1,690 profit in 60 minutes from the announcement. And also more recently, we've had that 600-point move in 48 hours from the October FOMC, which Mark Vunani will be talking through very shortly. So the Federal Reserve announcement, non-farm payroll announcements are very lucrative trading opportunities. So that is another secret for trading gold in 2015. The next one is going to be on the 16th of December. The fourth secret to trading gold in 2015 is using technical analysis and trading within the primary trend. So what I mean by trading within the primary trend is we analyze whether the market is trending upwards, downwards, or sideways, and we need to take note of the primary trend. Now, the primary trend is very important if you are building a core position. So you need to be very aware of the market, the direction of the market, and if we look at gold over the last 4 years, it has been in a downward trending channel. Overall, you want to position yourself short on gold over the last 4 years. You can trade within that primary trend. You can certainly go long, you can sell short on intraday moves. But if you're building up a position, all the big money is made within trading from core positions, from being able to stay into a position for a long time and being able to take advantage of that opportunity and also ride those bigger moves. Those longer term moves is really where you're going to make a lot of money. So it's very important that you're aware of the overall trend. So the overall trend on gold at the moment is very much a downward trend. We are coming into a time of year, which I'll talk to you very shortly about seasonality-wise, where we would expect potentially some upside with gold in the coming weeks with the Santa rally, which I'll talk through a little bit in more detail shortly. But overall, as we come into next year, after January, we're expecting that downward trend to be maintained. Any breakouts towards the upper end of that trend line, we are going to position ourselves again for additional sell shorts as we go into next year for the primary trend. And the way you can determine whether a market is in an upward trend or a downward trend. Very simply, you want to go out to you can look at the daily, but also look at the weekly and the monthly charts as well. Go bigger picture, so we go from the top down. And if we have higher highs and higher lows, so you've got swing lows and swing highs, the market is in an upward trending market. And the way you would trade this, if you're trading a core position, so let's say you got in from this pullback here. When the market continues to rise, as it continues to rise and pull back again, you have opportunities to trade within this downward trending channel. This upward trending channel, you have opportunities to trade as the market sells off. But as a longer term trader, if you're trading a core position, what you would be doing as the market continues to make higher lows is that you would very simply be moving your stop loss to each new swing low in order to ride the market for a much longer period of time. And this is what a lot of core positions and swing traders will do, where the stop losses will be on the market. And you can ride some huge trends. You look at oil this year. Oil has broken down to 3-year lows. You can see just going on the daily chart, all the different swing highs have been all the opportunities just to continue riding that trend. It hasn't had a change in trend over the last 5 months or so. It's been a fantastic trading opportunity, and we look to do the same in gold. There's two ways you really want to be trading the markets, particularly gold. One is have a core position, so you want to be trading with the overall trend of the market, and you can just hold on to those positions. You're only going to be taking new positions on pullbacks, let's say maybe 4 times a year. You're not going to be taking regular trades, and you're going to let that position really build some momentum over the year. You don't need to be checking it very often. Essentially, you're going to be just riding that overall trend. And then as a day trader, or perhaps a swing trader as well, there will also be opportunities to trade within that channel as well. You may wish to use a separate trading account or the same trading account, but that's different to your core position. You leave your core position alone and you take advantage of the day trades within that channel as well. Exactly the same for a downward trending channel. So with gold, what we've seen recently is if you have a look at the daily, and we'll have a look at this shortly, we just continue to sell off each new bounce, and we start getting a lot of interest from analysts in the market. When we start seeing any sort of rally on gold, it gets a lot of traders excited, particularly the bulls gets them very excited, and we often see a lot of news coming out of CNBC and various publications saying it's the start of a new bull market. Gold has reached a bottom. It's very dangerous to try and pick a bottom on the gold market at the moment. I definitely wouldn't be doing that, because we are continuing to get lower swing. We're continuing to get lower highs and lower lows as we continue with this downward trend. So let me just show you here. This is the 10-year chart for gold. You can see when we started we started this downward trending channel from 2011, and at the moment this is the monthly. So we are due potentially some upside here, which we will be looking at in seasonality. So as we go into December, the Santa rally is often what we see in the equities, and this follows through to gold, and we be potentially looking for a breakout towards, if we continue the momentum, we have broken out a little bit to the upside towards $1,220 an ounce is our next level, where we are going to be looking as a sell zone here to trade back within the overall trend. Now, it may take up until January for us to come up to that level. Then from February onwards, we will be looking to position ourselves for a sell short again into the gold market. So we'll be looking to take advantage of that and trade within the overall downward trend. So let me talk you through the 5th and final secret for gold, which is very important this time of year, and particularly if you have gold positions on, or if you're looking to get into a position on the precious metals at the moment. And that is the gold seasonal cycle. So if you remember, we talked about the daily cycle, which we get in gold. Gold also is very predictable at different times of year. It has very clear cycles which occur throughout the year. So gold seasonality is a 32-year historical chart for gold. Okay, so what you'll notice here, let's go into where we are at the moment. Okay, so we're mid-November at the moment. So we've got Thanksgiving coming up very soon in America, and this often marks for the equities as well as the commodities. This is when we start to see the build-up for the Santa rally, and the Santa rally is characterized by a lot of good feeling in the market. A lot of money starts to come into the equities market, into the metals as we go into December, particularly in the US for tax purposes. We see a lot of reallocation of funds into the market. So we see this in equities. We see it in gold as well. We often see a rally from November through to December, through to the first 2 to 3 weeks of January. This is a very common cycle. It's been happening for over 32 years now. As we go into January, we'll be talking about the January effect very shortly, but we often see a rally in January. Then February, this is the time when we really want to start positioning ourselves for additional sell short positions on the gold market. We often start to see weakness start in February and then really follow through into spring. So spring for the precious metals is typically a time of year of weakness. It's when the markets aren't as strong at all for the metals, and we start to see weakness develop from February through to March, April. They say sell in May and go away with the commodities, and it's very true for gold as well. And we often then start to see the market tend to bottom out. So as day traders ourselves or longer term traders, we are looking to position ourselves for sell shorts during this period. So the early part of the year, the spring, we look to position ourselves for sell shorts. Then often over the summer months, June, July, August, this is where the markets start to consolidate and they start to form a base. We certainly saw some lows being put in recently for the gold, the silver market, and this is a time of year where you can start to look to position yourselves. We often see traders coming back from their holidays from about mid to late August onwards is where the volatility picks up across the markets, but particularly for gold. And this is where we start seeing a pickup in the demand for gold, particularly in Asia. It's the wedding season out there as well, where gold is in huge demand. And we see breakouts to the upside over September and into October. Then we have various FOMC statements. The FOMC statements in September and October are the most powerful and the most day tradable, which you often see up to 600-point moves and beyond in just 24 to 48 hours. And then, of course, we're coming into November here, which is where we often expect the rally. So let me talk you through. So this is the overall picture, the bigger picture of gold. What you want to be doing to give yourself an edge as you go into next year, you want to bring it all together. So you want to bring seasonality together for an edge, how the daily cycle affects trading, how the US dollar index affects your trading gold, what the average volatility of gold is in any given day. And then you become a real specialist at being able to trade gold. You get to know it. You get to know its nature. It is a commodity, and it becomes very day tradable for you. If you get to know a market this well, and like a lot of our traders, you get to understand the market, its ebbs and flows, you can really make a lot of money trading gold on a day-to-day basis. So let's talk through the January effect, because I see the next big opportunity really on gold for those of you who might be new or even those who are experienced, being the January effect. So this occurs when investors sell an asset in December, and watch out for this. It's occurred for the last 3 years, particularly on gold. That week between Christmas and New Year's, we see a lot, the volumes are a lot thinner on the markets, which mean those funds and banks who are in the markets during that week are able to cause big moves on gold. And we've seen the last 3 years running lows be put in over the month of December, particularly the last few days. In fact, the 31st of December last year, we saw gold come all the way down to the 1180 level before it rallied. And this is for a number of reasons. It is also for tax purposes and traders investing their Christmases, bonuses come January as well. So this is a 3-year chart during the month of December and January. And you can see this is just showing you an example of what occurred this year. So we had a 900-point rally in just 3 weeks from the very end of December. 31st of December, we put in a low of 1,182 hands. So during that whole week of December, you're going to sit on your hands. You're not going to do anything. You're just going to wait for that buying opportunity. Once we get a rejection, you can see here we've got a very large rejection candle on the daily. This is known as a capitulation, when you see a new low be put in the market, but immediately the market turns around. We actually put one in play, platinum this week, a very similar move. We broke down to new 2014 lows. Immediately we saw the capitulation on the market, and we saw a lot of buyers come in at that zone, and then you produce a big bullish engulfing candle, which we had here on gold, and then we just rode that through, 900-point rally in 3 weeks. And we are expecting similar to occur this year as well. So just from the beginning of January, you see it across the markets, across the board, but particularly for gold, it works fantastically. So this is really the next lucrative trading opportunity I see, particularly in January. So bringing it all together. So again, the 5 secrets to trading gold in 2015. Number 1, the US dollar index trades inversely to gold. So if you are gold trading, you need to be aware of the US dollar index, what it's doing. You need to have the US dollar index chart up. You need to be able to look at that inverse correlation. So if, for example, at the beginning of January, we see that the US dollar index is breaking down, it's actually starting to break down a little bit. It's a bit toppy at the moment. If you bring up a chart and have a look at the US dollar index, we're getting some support on gold at the moment. So do make sure you pay attention to the US dollar index. Number 2, day trade gold with daily cycles. So be aware of the average volatility, 250 points per day. If you're in a gold trade and it's moved 200, 250 points that day as well, already you know it's time to get out of that trade, okay? And if it's hardly moved at all, you know there's a trade opportunity. And also take advantage of the daily cycles where we see Asia buying and we see a smackdown during the European and often follow through into the New York session. Number 3, know when to trade high probability news. So it's just having these key events in your diary. So the next FOMC statement, which is a very lucrative trading opportunity, will be Wednesday, the 16th of December. That is the next opportunity for trading the FOMC statement. Again, look at the US dollar index, what it's doing prior to that announcement, and you can position yourself to inversely trade gold. Number 4, use seasonality. So we've discussed coming into this time of year at the moment, as we come into November, we often start to see the beginning of a Santa rally. We want to get out of any long positions in the last week of December and then position ourselves for longs again into January. That's an edge of your trading combined with your technical analysis as well. And number 5, of course, trade within the primary trend. So gold is in a downward trend at the moment. So overall, our core position is going to be in a sell for gold, but we can trade within that core position. But overall, make sure you know what the overall trend of the market is, because you want to be, most times you want to be on the right side of that overall trend. You will make more money. Okay, so those are the 5 secrets to trading gold in 2015. And what I'll do, I'll just talk you through quickly how you can actually find out more about how to trade commodities with the Gold and Silver Club. We actually offer 2 approaches, which we found work very well for our traders. So we have a hands-on approach and a hands-off approach, trading services available. The hands-off service is very simply, you have live trade alerts, a weekly analysis of the whole week ahead, and also a copy trader available to you if you don't have a lot of time for trading or you prefer a done-for you service. The hands-on service would be a full training on technicals, fundamentals, and trading strategies, so you can learn exactly how you trade, so you'll be able to trade other commodity markets with us as well, and you'll also be able to really get a good understanding of technical analysis, fundamentals, and how to apply that to your day-to-day trading, building up a trading plan for you. So if you'd like to find out more about the hands-off service or the hands-on service, very simply come to see us just during the break. We'll talk you through the packages that we've got available. And what we'll do now, we'll just hand you over to Mark at Vunani, and we'll talk you through that gold trade and how you can trade using the local exchange.
It's always a pleasure to listen to an expert speak. I mean, I think if you follow those 5 steps, you're going to make money. Clearly, you're going to need a little bit more help. We went through it very quickly tonight. I just want to touch on, in terms of this, we have a relationship with the Gold Silver guys. We have licensed them as authorized reps under our license, so underneath our Vunani asset management license. The guys are regulated under our license. They can give you advice. They can engage with you. They are fully regulated in South Africa. So in terms of both the hands-off and the hands-on service, I just want to touch on the one in the top right-hand corner. I'm quite excited about that. We are rolling out a copy trade for our clients. So if you are unable to follow their stock tips, but you like the way they think, the way they trade, you can open an account, you can automate your trading, and every time they trade, we will do the exact same trade for you. The exact same entry levels, exit levels, position sizing, stop losses, etc. We are already running that for some clients. Clearly, we run this offshore and onshore for clients, so that because we're sitting in the JSE, and once again, I'm going to thank the JSE. Because we're sitting in the JSE, I've kept this example to an onshore example, a rand-denominated example. So, first of all, I'm going to go way back, though, to why commodities, and I've only got 4 or 5 slides, so don't worry, I'm not going to bore you with a lot of fundamentals and portfolio analysis. But we believe in commodities. Those are our 3 risk profiles that we suggest to any client who's constructing a portfolio. And you can see we're saying 5 to 8% of your portfolio should be in commodities. It is a no-brainer. We always say to our clients that at least 5 to 8% should be in alternative investments in commodities in a diversified portfolio. And that would be a basket of commodities. It wouldn't just be gold. Gold, silver, platinum, palladium. Clearly from a precious metals, you'd want to put softs in. You'd want to put some energy in. So clearly those are the sort of commodity products that gold, silver guys do cover for us. Where do you find these on the JSE? So if you go onto the JSE website, clearly everybody knows how to trade a gold share, and that's probably the worst way, in my opinion, of trading gold. Gold shares as a percentage of the RESI 10 index is minuscule. It's about 4 or 5% of the index nowadays. Platinum is about, I think it's about 6 or 8%. The rest of the RESI index is now made up mostly of iron ore and oil. So when you trade the RESI 10, which is the index of the top 10 resource counters in our country, you're effectively trading iron ore and oil with a bit of paper and pulp thrown in because of Mondi and Sappi. You're not really actually anymore trading platinum and palladium or gold in our equities market. But if you want to have a punt there, you can certainly have a punt on gold stocks. They move around, But for me, there's a lot of other exogenous variables that go into trading a gold stock. It's all about human resources, power. You know, there's all of these other variables that you have to take into account. So my preferred is never to trade equities. The other way you can play it is clearly Kruger Rands. We have a Kruger Rand on-screen price. You can trade the 1/10 or the full Kruger. It's on-screen all day, and you can trade the derivative on it if you want to get yourself some gearing. So that's another way you can trade gold. Thirdly is exchange-traded products. That's exchange-traded notes and exchange-traded funds. And I'm going to come back to that one because we like to play in that space, but we like to do it with a bit of gearing. The other one is the equity derivatives. Now, equity derivatives and commodities doesn't seem to make sense, but we have this genre called the International Derivative Exchange, IDX, where there are some instruments on IDX. These are foreign reference instruments that you can trade in rands, and some of those have a offshore commodity link to it. So if you look into, there's about 260, I think, IDX contracts that we trade on our exchange, and some of them have a commodity play in them. So you might want to have a look at the IDXs. And then clearly the metals derivatives. So we have a very robust active softs market, trades corn, white and yellow maize, it trades sunflowers, I think soya is the other one. And over the past couple of years, they've introduced other commodity products, and they have some foreign reference commodity products in there. And what we do have is a Quanto product there as well, which is a dollar, almost a dollar denominated contract that you can trade. But I think that one's a bit complex to talk about tonight. So we can do another session on the metal derivatives and Quantos another night. But I want to come back to this exchange traded product because it is by far the easiest one to trade. So what do we have on our market? We have these exchange traded funds, which are baskets of commodities. So you've got a couple of gold ones. You've got platinum, palladium. Those are the main ones you want to, if you're going to get into any precious metals. So there's a couple of them from different providers. Mostly it's ABSA. But the one that's our preferred one is GLD. You also have some exchange traded notes. So these are not, the difference between an exchange traded fund and an exchange traded note is an exchange traded fund is a unit trust. It has to comply with the collective investment scheme, and it's an exchange traded unit trust. An exchange traded note is actually just a note written by a bank, listed on the exchange, and your counterparty risk is against that bank. So clearly most of these are written by the big banks, so your risk is very, very limited that they're going to default on that note. So this is a note that's linked to an underlying commodity, and you can see there's a lot of these. So there are some, there's coal, gold, platinum, palladium, silver, and then there's some softs. So that gives you another way of getting into the market if you want to trade an exchange-traded note. Now these are all Delta 1. There's no gearing on these. So these for us are great portfolio plays and something you put into your diversified portfolio, but they're not very exciting. They're not very sexy on their own. So what you need to do is you need to add some gearing. So you've seen this chart earlier. So this is clearly not my trade idea. This is the gold and silver guys. So they gave us this setup. They showed us the move. And I thought, let me translate that back into something that you could have traded if we gave you that setup locally. So the way we're going to do this, this is Gary Boyson who used this title. It's a fund with a fact sheet and everything. GLD is a unit trust. It is on exchange. You can get a fund fact sheet. You can see exactly how much gold it holds. And roughly what happens here is you take the gold price, you times it by the exchange rate, and you're pretty much at where, and divide by 100, and you're pretty much at where fair value should be on the GLD, on the gold exchange traded fund. But they don't quite have a full hedge ratio. So they've got about 96.39%. That figure changes a little bit. You can get that figure from us over time. So you factor it, you take the gold price, times by the currency, times by 0.964, and you roughly get where the fair value for GLD is. So at the time that trade was signaled, gold price was sitting roughly at 122.170. The exchange rate was 11.04 in rands. And clearly, you're never going to be able to translate this 100% into when you trade it in rands because you've got a rand that goes the other way to the gold price. They tend to be negatively correlated to each other. But you're still going to grab some of the action. So the GLD fair value was 130.01 at the beginning of the trade. You can see that 600, what Phil called a 600-point move. GLD moved from 130.01 to 123.86. So in its own, if you went short GLD, you would have made yourself 4.97%. which is reasonable. I mean, that's okay. It's not very exciting. And what you do then is you use either, and this, you use the derivative, the exchange-traded CFD that's available on the JSE, or you use the single stock future. Both of them do the same thing for you. Our preference is the ECFD because it's a one-to-one. One contract equals one share. You would have gone short the ECFD, which is geared roughly about 12.4 times. And that move of 4.97%, you would have translated in 61.5% on that trade. So that's what I'm suggesting to you guys, is there are instruments on our local exchange that if you take these signals and you trade them with our guys and you trade them correctly, you can make some substantial performance out of these. So, I mean, any time that there's a gold trade of reasonable moves, Nick and Phil's signal, you can play them on our exchange. So the CFDs, ECFDs, and single stock futures that are available to you, as you can see, there's gold, platinum, palladium, and you can trade the resi as well. So any of those sort of trade ideas that come out from the Gold Silver Club that you want to trade on the JSE, we can certainly facilitate you. What you need for this is clearly you need what used to be called a SAFIX account. It's now called the Equity Derivatives Market Account, and we can trade this via that SAFIX account for you. So that's about it from my side. Hopefully I've taken one of those dollar-denominated trades and shown you how you can use the South African instrument to clearly also follow that trade.